Thank you. This is Mark Sobel, U.S. Chair OMFIF. Antoinette's going to be joining us by phone due to technical difficulties, but even though we won't have the pleasure of seeing her smiling face, we're delighted to welcome her. She's Deputy Managing Director at the IMF, another high-level position in her distinguished career. At the Center for Global Development in past years, she co-chaired the last replenishment of the World Bank's Fund for the Poorest Countries. She headed the IMF's Africa Department from 2008 to 2016. Before that, she was Liberia's finance minister, where she led her country's efforts to secure multilateral debt relief and strengthen public management. She was a longtime World Bank staff member. And one of the things that always impressed me in my dealings with Antoinette is that she was always smart, thoughtful, gracious, and kind. And everybody on her staff absolutely loved her, which is a rare achievement. So welcome, Antoinette.
Thank you so very much, Mark.
Thank you. Well, thank you for joining us. Great to have you. Let me just give you the floor and let you tell us about your impressions of the fund's response to the crisis.
Well, Mark, thank you very much once again. And really, most unfortunate that we've had these technical problems today. I was very much looking forward to actually seeing you and others in this conversation. But I'm thrilled to be here nonetheless and to talk about what the fund has been doing. Of course, we all know that this is an exceptional time across the world, calling for really exceptional action from all of us. And the fund has certainly been very busy trying to do its part, trying to make sure to respond to the unprecedented requests for assistance we've been seeing from our member countries, and to do it as fast as possible. And we've never done this type of response as quickly as we've been doing it. And so I think it's best to summarize maybe how we've approached the issues, focusing on 4 areas. Certainly, the first area, of course, is on the emergency financing front. And we've been responding to calls for emergency financing from over 100 countries. And so far, that is beginning in mid-March through the end of July, we have already disbursed some $30 billion to 75 countries, 47 of those countries being low-income countries, to really make sure that they have the resources they need to respond very quickly to help expenditures, to put in place some basic safety net efforts to sustain the livelihoods of people affected by the crisis as well. We've also doubled the access to our emergency financing facilities. So the Rapid Credit Facility and the Rapid Financing Instrument, the first one being the concessional emergency financing instrument, and the second one, the GRA, or the non-concessional fund lending. And we've raised the access limits from 50 to 100% of quota for both of those instruments, and that has really helped us to make sure we get the financing out quickly. We've streamlined our approval processes to make sure that the board was able to approve things quickly. And we're working very hard to increase the volume and the amount of concessional financing that we can call on in the next several months or in the future, to make sure that countries that have had, of course, exceptional financing through the RCF are able to continue to benefit from follow-on programs that most of them will want and will need. So in that respect, we've made very good progress raising money for the Poverty Reduction and Growth Trust. That is our concessional trust fund and the source of financing for our low-income member countries. The board just recently also increased the annual access limit to financial support so that countries who have benefited from emergency financing and when they were hitting their access limits so that they wouldn't be able to draw on more financing under new programs, now have the opportunity to do so because the annual access limits have been raised. And for GRA users, the non-concessional part of the fund, raising that from 145% of quota to 245% of quota, and for the low-income countries with the PRGT from 100% of quota on an annual basis to now 150% of quota. So that is going to be very helpful in the months ahead. We, of course, also added to existing lending programs that some countries already had to allow them to have additional resources to respond to the crisis. So that all of that is on the financing front, the emergency financing side. I think the second area we focused on, of course, was to make sure that we work to enhance liquidity. We introduced a new short-term liquidity instrument, and that is one that the SLL, as we call it, that will be available to member countries with very strong policies and strong fundamentals, and who are in need of short-term, moderate balance of payments support. And as you know, Mark, we've also had for some time our flexible credit line, and the board has just recently recognized very strong economic fundamentals of two countries, Peru and Chile, who've received FCLs. And that, of course, in addition to Colombia, which has had an FCL for some time, but a new one was approved in May. In addition to the one that Mexico has, we now have 4 countries benefiting from the flexible credit line with funding in that precautionary funding in that of $107 billion. So all of that, I think, very much in response to countries' needs for emergency financing and for the backstop that the SLL and the FCL can provide. The third area I would flag and underscore is our tremendous work on debt relief. We've provided ourselves immediate debt relief to 29 of our poorest member countries. We were able to do so by using something we call the Catastrophe Containment and Relief Trust, the CCRT, to provide grants to those countries. And with those grants, they have been able to service their debt to the fund, while at the same time making fiscal space, additional fiscal space to respond to the crisis. And we were only initially able to do that for 6 months. That runs from April to October. We've been raising more resources to be able to extend that to 2 years, and we're making progress there. As you know, Mark, also we joined together with the World Bank to urge bilateral creditors, official bilateral creditors, to suspend debt service payments from the poorest countries. And the G20, of course, responded to that with the Debt Service Suspension Initiative, or DSSI, as we call it. And that has been providing support for a number of countries. 41 of the 73 eligible countries have already applied for the DSSI. We at the fund have been working, of course, to support that process. And very so far, 41, more than 50% of the countries, and we expect additional countries to also apply for DSSI. The last area I would flag is our capacity development work. Our work on technical assistance and training adapted to this crisis environment to help countries that are benefiting from financing to make sure they had support in strengthening economic institutions that will enable resilient, inclusive policies as the recovery begins. So we've been integrating our capacity development support with our financial support in response to the crisis. And over 90% of the countries that requested emergency financing have benefited from that. Just-in-time support, hands-on technical assistance, practical tools, policy making, focusing on urgent issues, cash management, financial supervision, domestic resource mobilization, of course, and just budget execution issues around the social spending side. And of course, we recognize that debt is a big issue will be a very big issue for a number of countries. And so we expect to be, and we have been already providing quite a bit of capacity development support to resolve debt challenges, improve debt transparency, of course, and strengthen debt management capacity. So those are the four key areas. I should say in closing this first segment that we, in light of the need to focus on our priority of getting financial support out quickly and capacity development support quickly for our member countries, we postponed some of our surveillance, bilateral surveillance work in the form of the formal Article 4 consultations that we do with all member countries. Nonetheless, we continued bilateral surveillance in an adapted way, providing policy advice very actively to member countries, various policy notes around issues emerging from the crisis, and the policy tracker allows us to capture what countries have already done on the policy side in response to the crisis. So all in all, the fund has been very busy, as you hear me describe, at the center of the global financial safety net, and really deploying our entire lending capacity of about $1 trillion, as well as the intellectual firepower and the capacity development capacity we have. All of that to serve our membership in the best possible way.
Well,
so let me stop there.
Okay.
Yeah.
Thank you for that excellent introduction. As you noted, the fund's played its first responder role in an excellent manner. Of course, that's just the beginning. Emerging markets and LICs, low-income countries, are going to be hit hard by the crisis. Lost revenues, increased spending needs, lost tourism, lower commodity prices, lost remittance flows. So one could imagine that some are going to be pushed into clearly unsustainable debt positions, and others into a situation where debt sustainability is questionable. So let me start with the questionable cases. So the countries didn't cause the crisis through bad policies, but they're hit nonetheless. They may need more fund support, which likely means adjustment needs and fund programs going forward. But perhaps given the circumstances, the balance between financing and adjustment should shift more towards liquidity support, as is customary, provided that you're not loading up countries with debt excessively. I mean, do you agree? And how should the fund do that operationally? Some former fund staffers have suggested you set up a new pandemic facility to cordon off precedents for normal times.
Yeah, no, very, very pertinent question, Mark. And I very much agree that our lending programs will certainly need to adapt to a very different world and to the evolving and very uncertain nature of the crisis we have. And we'll have to use increased flexibility, some innovation to be able to do that. I think it's as you say, the balance between adjustment and and financing is quite relevant in this context. The focus, we think, on macro stabilization first and foremost to cushion the impact of the crisis and limit potential long-term scarring is a priority in the design of these programs. And I mean, of course, in many countries, there's a large agenda of structural reforms that needs to be carried forward. But in the short-term perspective of the next year or so, and with many uncertainties around us, it's very difficult to design an appropriate structural reform program that really looks to what the economy will look like coming out of this crisis. So there's a case, of course, for some very urgent structural measures that are important to macro stabilization, being perhaps a focus of these early programs. But by and large, the focus has to be on the macro stabilization front, and then starting these larger reform efforts later. In addition to that, of course, the authorities' bandwidth for taking on these more medium-term reforms is limited as they're struggling to deal with the health crisis, to deal with the need for safety net support for their population. So that's one way I think that we have to think about programs. We also have to, of course, given these uncertainties that I talked about, and the fact that the macro framework may need to be revised more frequently, our reliance, typical in the typical fund-supported program on quantitative targets has to be less. Because it is not practicable to actually be able to stick to those targets with the framework being changed frequently, and then being able to capture what has been the effort of the authorities to meet those targets. So we'll have to move to a more holistic assessment of the policies being implemented by maybe looking a bit more at some indicative targets as well, and then of course working with countries to design contingency plans that can help them respond in case of downside scenarios materializing. So that's on the program monitoring side. I think we need to look at a more holistic way of evaluating performance under the policies there. And I think maybe a last point on program design is that, it's a very different world. There's very different challenges countries are confronting. It suggests that we need to be, these programs should be more readily accommodating some unconventional policies as part of a broader policy framework. And I say that while, of course, wanting to underscore that this should be done very carefully, because some of those policies, for example, regulatory forbearance, central banks purchasing, government and corporate assets, and perhaps some capital controls, even those have to really be looked at very carefully as part of a broader reform program. They can be costly, they can be difficult to exit, and they can really create problems for a country seeking to maintain its access to capital markets. Capital controls, for example, are being imposed too readily. So, having said all of that, we certainly need to take on board the need to look at some of those measures where they're necessary. And so that's another feature of how to look at the program design. So as you can see, we've been really thinking through how to better align our lending instruments, to the needs of our member countries. Countries are moving from the containment stage to stabilization, recovery stage, coming eventually, and our programs have to be adapted to those challenges. But we take the point, of course, that in this suggestion, this proposal of thinking about a pandemic facility, that seeks to ring-fence the pandemic sort of responsiveness of programs to make sure that they don't create situations where in the future our existing programs can't be themselves again, because we use them to adapt to this crisis and they don't then step back. So it's worth considering, to cordon off precedents for normal times But there are other factors, I think, that come into play. We're looking at all of those issues, hoping, certainly planning to come back to our membership with further thoughts on our lending toolkit and what needs to be adapted there. So I think those are the issues around the coming programs that we see. Of course, as I flagged before, we're working hard to mobilize resources for the PRGT, given our expectations of a large financing need for the low-income countries. And in that respect, we've had a very positive response with our member countries providing resources, loan resources to the PRGT, using the existing SDR holdings to do so. We certainly are looking forward to potentially other contributions, hopefully including from the U.S. that could send a very powerful signal. We're also working to mobilize subsidy resources to allow the PRGT to continue to be the concessional instrument that it is. And there again, the U.S. could play a role in providing grant financing for that purpose. We're also continuing, as I said before, to raise resources for the CCRT because we want at least a 2-year time frame for debt service relief, fund IMF debt service relief for our poorest member countries.
Okay.
So those are the issues we're working through for this next phase of the crisis.
Great,
Mark.
great. Well, I want to say that I would love personally to see the United States contribute $1 billion to the PRGT subsidy resources and the CCRT. I'll let the U.S. figure out if they're going to do this or how to distribute it among the two. But I think that would be a wonderful sign of international solidarity from the United States.
It would be great. It would be great.
It would be. It would be. Well, let's turn to the DSSI a little bit, low-income country. You suggested good progress. I think the DSSI makes a lot of sense in principle to give debt service relief amid the fog of the uncertainty, and to have it as originally stipulated from the private sector and the official bilateral creditors. Great in principle, but I think there's a perception that it's been somewhat disappointing. The private sector isn't playing ball, and it seems that many key countries are wary, fearing it could hurt their credit ratings and access to private capital, and that's not worth 6 months relief. There are some questions around whether key bilateral official creditors are playing ball. We can come back to that. The G20 finance ministers didn't agree in their last communique to extend the DSSI. So do you have any thoughts about this? I mean, should we be more upbeat, and why, and how do you get the private sector in?
No, thanks for that a very important question, a set of questions. The DSSI is actually providing relief over an 8-month period, beginning in May through December of this year. And so far, as I said before, more than half of the countries that are eligible have applied for it, and that elicits a $5.3 billion debt relief for them, which is for those countries considerable. It's quite a bit. So I think it's a glass half full, not a glass empty. And I think some of the expectations around it, of course, come from the severity of this crisis and all of us wanting to see much quicker action, fully cognizant of the huge pressures on these poorest countries. But it is true that this is the first time that the international community has sought to provide debt relief to 73 countries all at once. And that has naturally elicited a number of challenges there, including around private sector participation. And some of the fact that hasn't materialized reflects, I think, the reluctance on the part of some debtor countries to seek, this 8-month relief, as they see it, at the risk of being downgraded by rating agencies. And the private sector also is not voluntarily offering terms that are comparable to the official sector. Given the world that we all live in now, it would mean extending maturities at below market interest rates for them that they judge not feasible or possible for them. But having said all of that, there's been a lot of work going on. The International Institute for Finance, World Bank and IMF work, Paris Club work to try to explore ways of increasing the private sector participation. Not fruitful so far. A number of proposals around credit enhancements, deferential treatment of deferred amounts in the eventual restructuring that some countries will have, but not yet seeing broad support for that. And the DSSI, in a way, it can be seen as quite unusual because it didn't require comparable treatment of commercial loans. Maybe that's considered down the road, but if that's the case, some countries would then be obligated to seek private sector participation, and given the market conditions, this may well mean that some countries choose not to apply for DSSI because they're still quite concerned about maintaining their access to the market. And so those are some of the challenges around the DSSI. But we certainly are looking to report and report to the G20 in the fall on whether to extend the DSSI beyond this year. And we stand ready to continue to help to make sure that the implementation goes forward.
Well, let me ask you about one other perceived DSSI challenge, and that relates to China, which is the largest official bilateral creditor. I think its DSSI participation is seen as fairly opaque by the outside world. So China Development Bank and the Export-Import Bank for China are the two main agencies for official credits. China Development Bank does not appear to be taking part, and I noticed that David Malpass called for China Development Bank to participate. It's also unclear whether EXIM financing with commercial banks or the co-financing with commercial banks is included. So, does the fund have a good handle on these issues? The numbers, are you speaking to the Chinese? And of course, we're just talking about debt service relief, but should China join the Paris Club and follow its principles at least, and write down official debt as needed, as was done by many of the G7 countries at the time of HIPC and MIDRI, and was done for your country when you were finance minister?
Quite a few questions there, Mark. But yes, China is indeed the largest official bilateral creditor to DSSI countries. It's also the largest contributor. So far, the $5.3 billion I referred to earlier in suspended debt service payments, China has really contributed 1/3 of that $5.3 billion that is now benefiting 25 countries. So that is noteworthy, I think, in terms of participation. China has been participating through two of their lending institutions, China Exim Bank, as you mentioned, and then the China International Development Cooperation Agency. CDB, or the China Development Bank, is not participating as an official lender because China considers that it is, in fact, a commercial lender. And the Chinese authorities have nonetheless stressed that the CDB is participating as a commercial lender on comparable terms, and that it's received several requests. I think we're certainly working with countries to work with China in the context of the DSSI, and to make sure that they can benefit from the fullest support from China. The fund, on information, I think, we're certainly benefiting, as in the past, from excellent information sharing with the Paris Club lenders on DSSI implementation. And we do get quite a bit of detailed information also from G20 lenders that are outside of the Paris Club, from the data that is collected by the G20 itself, which has quite a bit of detail in terms of institutions, amounts involved, etc. But I think you rightly flag an issue that we think needs improvement. The information sharing arrangement, if the DSSI is going to be extended, that should be a priority for improvement, we think. And another area for improvement also is really for DSSI lending institutions to really use a common framework. As you know, the Paris Club has an MOU. To get to a common framework would be the best way of moving forward with a potential extension of the DSSI. So we're looking forward to laying out those issues when we put forward the report in the fall.
Thank you. I hope one day for China to join the Paris Club or the Beijing Forum or whatever you want to call it. Just a very quick question. The DSSI, the logic of it could apply to some emerging markets as well. Is there any way to extend DSSI, maybe voluntarily, to emerging markets, or would the same problems just arise?
Quite an interesting question, I think. Whether I would certainly worth leaving it on the table for consideration, but it seems to me that there are actually three facts that suggest that this is a lower priority. I don't mean to say it's not something to be considered. The first issue is that given the quantitative easing we've seen in advanced and major economies around the world, most emerging market countries are actually still having access to market financing. The limit, of course, for the frontier states and low-income countries are not having that access. But the emerging market countries are, most of them, many of them. I think the second point is that emerging market countries generally have much less official bilateral debt. And so the benefits of the DSSI for them would be quite typically much smaller. And then the third issue is that, as you know, Mark, this was a big political decision by the G20 to respond rapidly and try to support the needs of these poorest countries in an exceptional crisis. And it's somewhat of a more difficult political decision, I think, to make in supporting emerging market countries, some of whom have income levels in the same range as some of the G20 countries. To look at, but perhaps as a lower priority relative to the need to really make sure that the DSSI fully serves the poorest countries.
Okay, well, thank you for that. So coming back to just fund support, earlier this year, the fund staff said for 2020, there'd be a EM-LIC financing gap of $2.5 trillion, which would be filled through adjustment reserves, debt relief, IFI finance, et cetera. I think the fund has $225 billion on hand from quotas to lend out. There's $550 billion of backstop resources. So it seems that the fund has enough resources for now. But as we discussed, the medium term hit from the crisis will be severe. Do you have updated estimates on how the fund sees the medium-term financing gaps and how the fund is thinking about evolving resource adequacy over the longer haul?
Yeah, as you can imagine, Mark, we've been, of course, since the outbreak of the crisis, really monitoring the implications of what's going on for the fund's resources and looking at the emerging needs and making sure that we're in a position to respond as quickly and fully as possible when countries need financing from the fund. And we feel fairly confident, very confident at this stage that our lending capacity has about $1 trillion, and it's quite adequate. We don't currently see the need for supplementing those, even calling on the new agreements to borrow or the bilateral borrowing arrangements, not yet necessary. So having said all of that, we of course continue to look at what may be larger medium-term financing gaps. I'm not in a position to share specific numbers on that at this stage, but we're certainly continuing to look at those needs to make sure that our resources are adequate beyond the near term. And in that context, of course, steps to ensure that the fund would have such adequate resources were taken back last year when the annual meetings agreed to this package of doubling the new agreements to borrow and an additional round of bilateral agreements beyond 2020. So those are avenues that can be exploited if the need arises. But at the moment, we're quite comfortable that we have what we need to respond.
Good. Well, let me ask you a final question. Are there any special goals or priorities that you have that you'd like to accomplish during your DMD tenure?
Well, Mark, this has been certainly the most monumental point in my own career, the most challenging point in my own career, and the one I'm most grateful for in many ways, in the sense of being in the midst of a crisis like no other like this, and being at an institution at the center of the global safety net, it being asked to respond in ways it's never been asked to respond to. So with any crisis, of course, there are opportunities, and we have significant opportunities with the very strong and visionary leadership we have in our managing director in the fund, and the circumstances we're responding to really look to the prospects of helping to build a better world coming out of this crisis, and a better world in the sense of one that is a more equal world for sure, and one that is a greener world, and a number of opportunities that we can use to make that prospect even more likely. As you know, in response to the global financial crisis, of course, lots of efforts were made to strengthen the banking systems and make them more resilient. We have an opportunity today to put in place measures that promote a green recovery and inclusive recovery. So we can look at what incentives to private investments that could support low carbon and climate resilient growth. So we can, of course, put in place public investments that seek to do so. And there are many types of investments one can think of that help at the same time creating quite a few jobs. Land restoration, reforestation, even insulating buildings, a whole slew of things that can be pursued. And we have low oil prices today. It helps us to eliminate harmful subsidies to introduce carbon pricing that would be an incentive to future investments. So all of those really welcome opportunities to exploit. And of course, on the inclusive growth side, we have reason to fear an outcome of significantly more inequality and increased poverty from this pandemic, as has happened in prior pandemics. And we have estimates from the bank, of course, the World Bank, that suggest that up to 100 million people worldwide could be pushed into extreme poverty. That would erase gains that have been achieved over a number of years. So we have to try to avoid this by really investing in people more, investing in the fabric of our societies, access to opportunities improved for people across the gamut. We need to concentrate on policies that will reduce inequality. And the fund inequality, the fund wants to be part of that big effort to push forward on that. It means scaling up public investments in healthcare and social safety nets, education, fintech, of course. It means female labor participation that is boosted as well. So our managing director has said before that really the best memorial we could build for those who have lost their lives in this pandemic is really to create it's a greener, smarter, and a fairer world. And so that I think is what excites me about this new role I have, and the opportunities it presents to really help to contribute to a different world than we have now.
Well, thank you for that excellent answer. I'm mindful of time. I guess maybe just another question. You ran the Africa department at the fund for 6 years. You came
for 8 years.
Yeah, 8 years. I flunked arithmetic. And before that, you were Liberia's finance minister. If you look back at when you began those tasks and then when you were leaving the fund as Africa department head and looking at Africa now, do you have any reflections about then versus now?
Well, one of the most unfortunate aspects of this crisis is that it could obliterate a decade of considerable achievements in Africa for no fault of its own, for no missteps in policy making. And just by a shock, several shocks actually, not just the pandemic, but for many countries who are commodity producers, much less lower commodity prices, especially oil prices, and for smaller countries that rely on tourism, of course, the collapse of that growth model. And for many countries like my own, Liberia, that rely on remittances quite a bit, a significant decline in remittances as well. All of those shocks all at once. And this is what Sub-Saharan Africa in particular is coping with now. That is frightening, really frightening, as to what the outcome of this crisis will be if the international community does not mobilize quickly enough to make sure that these countries are able to rely on the more concessional financing they need to get through this very, very, very rough patch, and to start to focus on the huge reform agenda that will help them recover. So we saw quite a bit of optimism in the time that I was at the African department. If you will recall that we talked quite a bit about Africa Rising, which it was at that time, and which it can be again. And we certainly want to continue to do our part at the fund to make sure that the African region, sub-Saharan Africa, is fully supported to withstand this crisis. But I certainly learned a huge amount from my time in the fund, working with policymakers in sub-Saharan Africa and using my own experience and having been on the other side of the table to help the fund to be even more attuned to some of the political economy challenges that sometimes make for much more difficult reform efforts, and the need to really understand those and use the opportunity to work with reformers in a very good way that can have good outcomes. So lots of lessons for me from my time in the African department, and lots to do in the months ahead to make sure we continue to be a very, very good partner for Africa.
Well, thank you for that. I mean, everybody recognized that you were a highly successful leader of the Africa department. I thank you for today. We got off to a slow start, but the middle and the end were well worth it. It's a wonderful tour.
I am so sorry about the delay.
Oh, well, modern technology, but it was a wonderful tour d'horizon of the fund and its current activities and thinking. I think everybody has been enriched by this conversation. Thank you, Antoinette Saillet. Best of luck.
No, thank you, Mark. Thank you so much for inviting me in, and I really hope to come and visit you once again in a way that we can see each other next time. Thank you.
Thank you. Thank you for all for participating today.
Okay.